Everybody, happy Wednesday. So, I got a comment on the fear of winning, the fear of success. And I think I appreciate the candor. It comes from, in this public comment, it's again on the video, do you buy breakouts or pullbacks? From Michael Pichardo. Thanks for writing in, Michael. Appreciate you. Um, he's been trading for 7 years now, and I guess he's been keeping stats. This year has been clicking, but he he's offsetting his winners too soon. Is the juxtaposition? It's a very long comment. I'll save it to you, but you could read it. He's a subscriber. Thanks for subscribing, Michael. And he has a couple of different strategies: overmarket, overnight, and pre-market. And basically, the thing is, like, I have a fear of success, which is really brazen. I appreciate your honesty, I believe, because everything is clicking, and I just got everything clicking this year. I take 3 and 4R trades, meaning he probably takes his winners off at 3 and 4R, even though his plan is to hold for 5. I mean, look, if you're at 4.5 and your target is 5, it's not an exact science. Don't beat yourself up. It's clearly 3, though. There's something going on. But, and he holds for a day or two. He has a few strategies. I need a mechanism that will allow me not to be so anxious when close to targets or letting it run further. You talk about this a lot, and I keep doing it and convincing myself why take it, and then I regret doing it. I'm profitable, and I regret every win. This is great stuff. I should be way up. Way up. It's stupid behavior. Thanks. Love your show. Thank you, Michael. Appreciate you being here. It's a great thing about the show is, like, I know if people get benefit, I'm never gonna know probably 99% of them, but for the comments for the most part, or if they email me directly through the site. So let's think about this for a second. Picking a target in and of itself is very subjective. Now, I'm a guy who's read every book. I have access and have had access to the best traders who ever lived. And I will share with you, this might come as a surprise, that although I have a good feel, it's very, very difficult for me, even at my level, to predict, which is really what you're trying to do when you pick a target. It's to predict that it's going to go there or it's not going to go there, right? And what do I mean by not go there? Well, there's people who sell options, right? Because not only can you bet on where something's going to go with an option, you can bet on where it's not going to go. So, for example, if you're trading NASDAQ in today's day and age and it's over 17,000 basis to March, you might be able to go out to like 17.5 and sell that call. I don't sell naked calls myself, but that's betting that it's not going to get there, right? Because why else would an option expire worthless but for its intrinsic value, right? So you could also buy or sell a bear call spread to cover yourself as well. But that would be a bet on where something's not going to go. Same thing with using, puts that are below the market, right? You could sell them, but just be mindful that that hurt a lot of people in 87 when the market crashed because they were short puts below the market. And in one day, there was 28%. It's been so long ago, I forget. It was like 28% move in the index intraday. And those puts went from being fairly way out of the money to like way in the money. And the people weren't able to cover them fast enough. So there is risk, which would lead you to think maybe you would think about trading spreads, but to each their own. So what I typically try to do is I think of the market as a living, breathing thing. And a good hint here of what you can do to know that the move is over with good probability is look for reversal structures in your charts. Now, again, if you're looking at intraday stuff, that stuff is super random. So you might be very aggravated trying to figure that out. But that's your choice. If it's your choice to look at 1 and 3 minute bars or to look at 9 and 20 period moving averages over on 5-minute bars, you invite that in, right? So that, I don't mean to sound this way, but that's kind of on you. I don't like that feeling of frustration of trying to guess at moving targets when I'm looking at random data. So I don't do it. That's a choice. Like, I surrender to the fact that That's too much work for too little money. And so I don't worry about the short-term moves. I don't put a lot of importance on, does something move 5 points in 1 minute? I don't care about that. I'm looking for, if you're talking NASDAQ, what would excite me, 200-point move, because you can always position size something down to where it makes sense for you. And if you're trading $2 micro contracts, $50 and $100 really shouldn't impact you all that much, right? I know it's tougher for smaller traders, but that's where, you should have a job. You should be feeding that account and growing it by adding money to it, not necessarily by your trading. Everyone has a fantasy, right, to add and grow your account from $1,000 to 100 million. Good enough goal, I guess. You'd have to look again. We talked about this earlier in the week. What's the correct number of trades? If you know your math, you might find out that it's going to take you 40 years to get there. That's why it's important to keep good records and to know know the math, know the formulas, so that you can do those calculations and have a bit of a reality check for yourself. I knew early enough on, when I had to break up my money, I didn't know, because again, this is the conversation about picking price targets. I didn't know. I thought in terms of percentages. I said, okay, could a $10 stock go up to 12? So that's a 20% move. I didn't say $2. I just said, could it move 20%? It seemed reasonable, which would have been twice what the market was doing at the time. The total return on the S&P when I was starting out was about 12.25% total return, which includes dividends, which I think was about 3% on average. So, and I don't say I was looking at $10 stocks. I'm just using that as an example. You could say a $20 stock goes to 24. I was like, what's the probability of that happening? I don't need something to double. So when I broke up my 5K, I would say like, okay, I'll buy one risk unit, whatever the number of shares is, I'll commit, say, $12.50 or a fourth of my account to buy X amount of shares. I didn't care if it was a round lot or not. It was just given where the chart pattern is, does it have room to grow like 5 to 1? So if I risk $2, could it move, $10, for example? And I tried to fill up my humble little portfolio of 2 securities or whatever. Obviously, the margins for futures were much lower because the prices were lower. Gold was $200 an ounce at the time. So the margin was extreme, a fraction of what it is today, because they calculate it based on volatility of today's price, right? So if 10% volatility, is nothing, where back in the day you might have had, the 20-day ATR on gold might have been $4. Now it's $20 to $30, because again, 1% of a $2,000 contract is a bigger number. So the margins are higher, right? So the margins on everything were lower, save for the S&P, because they didn't create the E-mini at the time. So the margin for the 500-point S&P contract, I'm sure it was 35 or 40K. So it was institutional. You couldn't trade it. And then if I started to make money, I would allocate another $12.50, thereby having half of my account in long market value in a particular name that had the potential to go up, like I said, 20%. Because for me at that point, if I had half my money, I was looking at, and it worked out, I'd add, in dollars, $500 to $1,000 to my bottom line. So that'd be 10, 20% to the overall account balance after a longer period of time. And that was going to get me on a growth path to where I needed to be. Of course, there's drawdowns. And I can remember taking 5% hits, which were painful, but I knew where I wanted to grow my money, so I let my behavior follow where I wanted to be. And I can remember very early on fixing this issue, because I was so afraid of everything. I was afraid of losing money. I had no idea if anything was going to work. I was in the middle of where many of you might be in kind of figuring out what my style is, right? And again, I cut away foreign exchange. I stopped options. So I was really looking at futures margin and equities. And I can remember very, very early on being super aggravated with myself with this concept of price targets. Because as bright as I was, coming from the school that I came from and having teachers with Nobel Prizes, I realized, like, trying to guess where the move was, like from something going from 20 to 24. I remember I owned Wendy's, the quick service restaurant, and I took a winner too soon. And in this example, it went up, another, more than, if I had something that went from, say, 20 to 24, I think it was like $14 or $15, but it was a big brand. I can't remember. It's too long ago, folks. But it would be the equivalent of like buying something at 20, selling it at 24, and then watching it go to 30. Like, that aggravated me a lot. That to me was a bad trade, because I had already been in the winner. I had already been up, and all I would have had to have done is protected my capital. Again, don't forget, you risk 50 cents. There was only 4 ticks that got you to 50 cents. Why? Decimalization didn't happen. That wasn't invented yet. That might have been a concept, but it wasn't in practice, meaning stocks still traded in eighths. So you got an eighth, a quarter, 3/8, and a half. So 4 ticks against you and you're knocked out. It was very aggravating. So when I caught a winner, you can see now how this all shaped my emotional constitution, because it's like your timing had to be really, really good, which is why I tended to buy momentum, not pullbacks, because it was so easy to have 4 ticks against you if you were looking at risking 50 cents to make 250, right, on a $20 stock. So again, that's why I don't really judge people. I'm really judging you when I hang up. Don't get me wrong. I'm not judging you. The idea, though, is that I know I needed to make money. In the concept at the time and the environment was very different from where it is today, in that you have these mini and micro contracts, which I think are good and bad. What's bad about them is that it gives, like, you needed to have, the only reason I had a futures account when I did was because I was a professional. I had a Series 3, and I was sitting at the desk where I could execute the trades, right? So I had the training. But for clients coming in off the street, the minimum to open up a futures margin account was $125,000. And there was no self-directed trading. That was working with someone who had a Series 3, what they called an associate, right? You were an associated person, an AP, like Series 7, you're a registered rep. When you get your Series 3, you're known as when you get your Series 3, you're known as an associated person, an AP in the grand scheme of things, working for either an introducing broker, a futures commission merchant, commodity pool operator, or a commodity trading advisor. So I was with an FCM, and that was the only reason I could get a futures margin account with such a small balance. But for everyone else coming in off the street, it was $125K and $1 million, I'm sure, of net worth. Like, it was no joke. There was a big litmus test. Now, if you can fog a mirror, you can basically open up an account. I don't necessarily know that that's a good thing. Giving people access to the money and creating a micro contract so that they can churn their way to heaven, and knowing that only 5% of people make it, that means you're a 1 to 19 shot to make it, or better, it's 19 to 1 that you're going to fail. And that's not me being a jerk. Those are the industry numbers. So I knew in order to grow my money, it was too expensive, because 4 ticks got me to 50 cents. Plus, I had to pay, like, I get some discount, but the firm wasn't working for free. We didn't have free commissions. So I needed almost 15 cents, or 50 cents, excuse me, to get around, like, round turn. Quarter in, quarter out. So all of that came into, like, my holding period argument, because to trade very frequently really had a big impact financially on the account balance. So if you imagine that I did, on 50 cents round turn on 100 shares is $50. If I did 5 day trades a day, you do them right. So that's $50 is 1% of 5K. So imagine if I'm trading actively and I did 5 round turns, I'd have 250, 5% of the account just in commissions. So it was just way too much money. And I realized, like, the best thing that I could do is to sit on my hands, even in those moments. Like, if I was up 150, there were times when it came back on me 50 cents, but then it continued to move. And those were the ones that I considered blessings. So I didn't try to pick the tops anymore after that because it was too painful for me to miss out on those moves, knowing that I had to take on that second commission to offset the losing trade, which made losing money on the trade even worse because it was so expensive to trade. So I'm very careful about, why do I have a price target, right? Tomorrow I'm going to talk about, knowing how to filter these types of trades and having an idea. That to me is more of a filter or a screen to get into the trade in the first place. But anyway, I've been blathering on here for a while. Hope you find this interesting. If nothing else, it's a good history lesson on how things evolved for me, which, if you want to know more about, I'm happy to speak about. It's a very, very different environment then. Not better or worse, just different, right? We're all shaped by our environment. So maybe I'll talk about that tomorrow. Anyway, I appreciate you all being here, and I'll see you tomorrow.